Most people don't realize this until it's too late. They chase the hot ETF, expecting fast gains. Then the market crashes and their portfolio crumbles. But one ETF is built to weather any storm. If you choose wisely, one is all you need. Let's break down the 3 questions everyone asks when they hear about a one ETF strategy. First, can one fund really give you enough diversification? Second, what about growth? Isn't it risky to skip tech or international exposure? And third, why trust just one ETF with your entire future? In this video, you'll get real answers backed by numbers, real case studies, and proven performance. Stick around, because at the end, I'll show you exactly how much wealth this strategy can build, even if you're starting with just $500 a month. Most people think more risk means more reward, but with the wrong ETF, more risk just means more regret. It happens all the time. An investor finds a flashy sector ETF, maybe tech, maybe energy, maybe semiconductors. They see charts going up and think, this is it. But then comes the crash. In the early 2000s, thousands of investors loaded up on tech-focused funds. When the dot-com bubble burst, the Nasdaq lost nearly 80% of its value. Retirement dreams? Erased. Same story in 2014. Energy ETFs were riding high thanks to soaring oil prices. Then oil collapsed, and with it, energy stocks. Entire portfolios sank by 30 to 50%. Some never recovered. The problem wasn't a bad economy or poor timing. It was poor diversification. These ETFs were built around narrow slices of the market. No backup plan, no cushion. Single sector ETFs promise high returns, but what they really deliver is high volatility. And when things go wrong, that volatility turns into destruction. If you want long-term growth without gambling, sector ETFs are not the answer. They're tools for traders, not foundations for retirement. A true one ETF solution must be diversified across industries, companies, and risk factors. That's the only way to protect your future and your peace of mind. Building real wealth isn't about finding the next hot pick, it's about holding the right asset for decades. If you're only going to own one ETF, it needs to do 3 things extremely well: diversify, endure, and compound. First, diversification. A forever ETF needs to spread your money across hundreds, ideally thousands, of companies, sectors, and industries. That way, when one part of the market stumbles, others pick up the slack. You're not betting on a single trend. You're investing in the entire economy. Second, track record. Anyone can look good in a bull market. The real test is how your ETF performs when things get ugly. Look for at least 10 years of performance through both good times and bad. A real forever ETF survives recessions, pandemics, rate hikes, and keeps delivering. Third, low cost. This one is underrated. High fees quietly eat away your returns year after year, but ETFs with fees under 0.1% let you keep almost all the growth. Over 30 years, that difference could mean tens of thousands of dollars. So which types of ETFs meet all 3 of these standards? Only 3 categories make the cut: broad market ETFs, dividend ETFs, and growth ETFs. Each one brings something different to the table, but they all follow the golden rule: long-term compounding without unnecessary risk. Forget chasing the next big thing. These 3 traits, diversification, a solid track record, and low fees, are what separate noise from true financial freedom. Broad market ETFs. If you could only hold one fund for the next 30 years, these are the ETFs most investors would choose. Broad market ETFs are built for long-term investors. They don't chase trends. They don't rely on one sector. They simply track entire markets and let the economy do the work. Let's start with VOO. It tracks the S&P 500, the 500 largest publicly traded U.S. companies. That includes tech giants like Apple and Microsoft, banks like JP Morgan, and consumer staples like Procter & Gamble. It has returned an average of 10.41% per year since 1957 and charges a rock-bottom 0.03% fee. Then there's VTI, which holds over 3,500 U.S. stocks, from small caps to large caps. It gives you broader exposure than VOO, but with similar performance and the same 0.03% fee. Finally, VT, the global version. Nearly 10,000 stocks from both U.S. and international markets. It gives you global diversification in a single fund, though with a slightly higher 0.6% fee. According to Vanguard's risk ratings, both VOO and VTI score 4 out of 5, meaning they're moderately aggressive, appropriate for long-term investors who can handle short-term drops. If you're looking for simplicity, performance, and proven results, broad market ETFs are hard to beat. They're not about hype. They're about holding the whole market and letting compounding do the heavy lifting. Up next, dividend and growth ETFs. But stay until the end to see how much money this strategy can realistically build over time. Not all ETFs are built the same. Some focus on reliable income, others chase high returns, but both come with trade-offs. Let's start with dividend ETFs. These funds prioritize companies that pay stable, rising dividends. That means cash flow, even during market downturns. 3 of the most popular are SCHD, focuses on quality U.S. companies with strong fundamentals. VYM offers broad exposure to high-yield dividend payers. VIG targets companies with a record of increasing dividends for at least 10 years. All 3 have expense ratios at or below 0.06% and provide growing income over time. They're great for investors who want cash flow and peace of mind. Then there are growth ETFs, built for higher upside, but with more risk. The big names here are QQQ, tracks the NASDAQ 100 full of tech giants. SCHG focuses on large-cap U.S. growth companies. SPMO uses momentum strategies to capture short-term trends. QQQ, for example, returned over 20% annually over the past 5 years, but it also drops hard during corrections. Expense ratios range from 0.04% for SCHG to 0.20% for QQQ. Dividend ETFs offer stability and income, while growth ETFs offer speed with volatility, but neither gives you the full package on their own. That's why most long-term investors still choose broad market ETFs like VOO as their foundation. If you're looking for the best one ETF to hold long-term, the answer is clear. VOO is the top choice. And here's why. Let's break it down. VOO gives you instant diversification across all 11 major U.S. sectors, from tech and healthcare to energy and consumer staples. That means your money is spread across 500 of the largest, most profitable companies in the country. Together, these companies represent about 80% of the entire U.S. stock market's value. So when you own VOO, you're not betting on a sector. You're betting on the whole U.S. economy. The cost? Just 0.03% per year. That's $3 a year on a $10,000 investment, leaving more money to grow over time. VOO also pays a dividend with a yield around 1.5%, and those dividends have been increasing steadily over the years. That gives you not just growth, but a stream of income that keeps rising. And when the market crashes, VOO has consistently recovered. From the 2008 financial crisis to COVID in 2020, it has bounced back stronger every time. That's because the S&P 500, which VO tracks, is rebalanced regularly. Underperforming companies fall out. Stronger ones replace them. Plus, even though it's a US-focused ETF, many of the companies inside VOO earn revenue globally. That gives you international exposure without owning international stocks. With simplicity, low fees, dividend growth, and proven resilience, VOO checks every box. If you want one ETF to build your future on, this is the one that keeps showing up year after year. Let's get specific. Here's exactly how much wealth you could build with VOO, based on real numbers and realistic returns. To keep it simple, let's use a 10% annual return, which is close to the S&P 500's historical average. We'll look at 2 investors. One makes a one-time lump sum investment. The other invests consistently every month. Scenario A, $10,000 lump sum. After 10 years, $26,000. After 20 years, $67,000. After 30 years, $174,000. This is the power of long-term compounding without adding a single extra dollar. Scenario B, $10,000 plus $500 monthly contributions. After 10 years, $105,000. After 20 years, $380,000. After 30 years, $1.2 million. That's over $1 million from a strategy that anyone with a steady income can follow. You don't need to beat the market. You just need to be in the market, consistently and patiently. Let's be clear. This assumes you reinvest all dividends, which VOO distributes quarterly. Those dividends buy more shares, which generate even more dividends, and the snowball grows faster. You'll also benefit from VOO's rising dividend payouts. That income grows with time and inflation, making it a strong hedge in retirement years. This isn't just about retiring rich. It's about creating predictable, long-term wealth with a strategy that doesn't rely on luck or timing. VOO delivers steady growth, rising income, and peace of mind, which is why it remains the best one ETF to hold forever. If you found this breakdown helpful, check out my other video on building a 3 ETF portfolio. It's the perfect upgrade if you ever want to go beyond VOO. And if you want to grow your money without the stress of picking individual stocks, hit subscribe. You'll get clear, no-fluff investing strategies that actually work every single week.